Let's turn to the other big mover. That is Amazon, blowing past Wall Street's estimates in the second quarter, delivering the biggest earnings beat since February of 2021. The company showing resilience in its e-commerce business, which had dipped into the red last year after massive growth during the pandemic. Under CEO Andy Jassy, Amazon laid off 27,000 employees, which also had helped to boost results. However, not everything is rosy for the tech giant. AWS did grow by 12%, but that is the slowest pace on record. It was better than estimated, though. Let's digest all of this with Nick Jones, equity research analyst at JMP Securities, a Citizens Company. There's a lot to digest when it comes to Amazon, which is an increasingly complex company. Let's get to the e-commerce surprise first, though, Nick, because that did seem to be indeed the biggest surprise. How sustainable is that in a slowing growth environment?
I mean, that'll be the big question mark heading into the back half of the year. We already saw that the biggest Prime Day ever. So I think 3Q, we know at least the Prime Day was strong. A lot of the third-party data like app trends and traffic data suggests the consumer remains resilient. All of that said, personal savings are diminishing. So I think that'll be a big focus heading into the holiday season is how resilient can the consumer be. So far, they've been very robust and very resilient, and Amazon is benefited.
On the call, artificial intelligence, that key buzzword or buzz phrase was mentioned several times. What's your impression of how AWS and Amazon is positioning themselves in order to capitalize on this trend?
Yeah, Amazon has been investing in machine learning, AI type technology for many years. Their results this quarter were actually quite a bit stronger than I think the street was looking for. Particularly the commentary around what 3Q might look like, which is stable to potentially even accelerating. So what that suggests is they're squarely competitive with Microsoft within this space. We think there's a long runway for growth here. This is very, very early days. We're really encouraged by the results and the outlook.
What happens with AWS? You know, $22 billion now, but seeing this slowing growth, I mean, is it a trough at some point in that growth rate?
There's potential for a nice acceleration as we get into the back half and really into next year. As the macro situation continued to kind of pressure companies, a lot of the customers were focused on optimizations. They're trying to cut costs, get more work done with less. The commentary from the call was they're kind of working through that now and actually deploying more workloads into the cloud. That would suggest building momentum with all this new technology and the focus on generative AI, making it consumer-facing, helping internal operations at companies. It would not be surprising to see a nice acceleration as we exit this year and into next year. So this could be a trough, and we could be looking at a nice acceleration going forward.
And Nick, I'd be remiss if I didn't ask you about headcount on Jobs Day here, especially within the broader context of cost cutting, which you've touched on a little bit before. But is Amazon doing what it takes? I mean, just reading some of the analysts' reactions to it, it would seem yes. But can Amazon do more in terms of cost cutting? I think is the question I want to ask.
There's probably always more to do in cost cutting, but Amazon is still very much a growth company. I think what they delivered on operating income this quarter and then the guide they gave for next quarter really got the street excited. We see it in the stock price. There's always more to do in terms of driving margins higher. That said, they have a long runway in e-commerce. They have a long runway in advertising, which accelerated this quarter from last quarter in year-over-year growth. They have a long runway in cloud. So, I think that's a fine balance that they'll continue to toe the line on, invest where there's returns, and drive margin expansion when it makes sense.
Yeah, that balance is always fascinating to me when it comes to Amazon in particular, because it does throw a lot of money at other areas, right, where it does see that growth. One of the other places where it is investing is in facilities, particularly those same-day delivery facilities. Do you think that is the right place for them to be investing?
Yeah, I mean, the data that they're sharing suggests they can drive much higher utilization, which can actually drive margin expansion by getting consumers to, buy things that are going to come same day or next day. They're very focused on driving fast delivery and a very strong consumer experience that's extremely compelling, which is probably in part one of the main reasons they've been so resilient amid potentially a more pressured consumer. So we think that's the right move. They've always been focused on the consumer and providing a really convenient experience.
Speaking of the consumer and a convenient experience, one of the other areas in the past that they threw money at was grocery, particularly Whole Foods, a strategy that I think arguably has not turned out quite like perhaps they wanted. There was some reporting earlier this week that they're going to be consolidating their different grocery efforts, which as a consumer, a Whole Foods shopper, for example, gosh, that makes a lot of sense. It's so silly that they have all these different grocery verticals, isn't it? Like, how much upside is that going to afford them if they do that successfully?
Yeah, I think there's quite a bit of upside. I think it's a little bit hard to quantify today. But, there's discrete products, right? There's non-perishable like canned products, packaged products that can be stored on shelves for a long time. Then there's produce that can perish very quickly. So there's a lot of moving pieces there to try to get delivery consolidated. There's definitely some upside, but I think it's a little early to kind of quantify what the impact could be. I think the fact that they're focused on it would suggest they're going after a sizable opportunity. Otherwise, they likely would not be pursuing that.
And Amazon has a sizable stake in the automaker, EV automaker Rivian. How are those results being reflected in the current report? I know it's caused some volatility in the reporting before, but maybe a little bit less now. What are you seeing?
Yeah, a little less now. I mean, we're going to keep an eye on it. It's hard to kind of opine as to how that's going to play out because it's tied to kind of how the auto industry is performing, which has been hyper volatile as well. So we expect that to kind of ebb and flow with the auto industry, and we'll keep an eye on it.
All right, Nick Jones, thank you so much. Nick Jones is equity research analyst at JMP Securities, a Citizens company.